Distinguished ladies and gentlemen, let me stand on our existing protocols. And first and foremost, let me say I'm honored and privileged to be invited to be a keynote speaker in Vetiva's investor conference. Vetiva, as you know, is a household name as far as investments in Nigeria are concerned. They've played a role both as professionals in the investment banking world, but also in terms of their strong legacy and strong network and pedigree. So without much ado, the discussion this morning, this afternoon, this morning, is about the African narrative, COVID, geopolitics. And I'm going to start off by saying four key important issues. One, from COVID to geopolitics, that is three major transitions. Two, key investment opportunities, and risk footprints, and the summary and the conclusion. Well, let me start off by saying that we have three major transitions. One was the medical crisis. In 2019, everybody in the world thought that things were normal until November. And then something happened in a lab in Wuhan, and the rest, as you know, is history. In all, I think we understand that 15 million people have died so far, more than 1.5 million in the US and 1.2 million in sub-Saharan Africa. That is frightening. But compared to 1918, where we had the first Spanish flu, and the world population in 1918 was less than 2 billion people. Today, we have about 8 billion people. We lost 17 million people in 1918. 110 years later, we've lost 15 million people. And we've lost, and the economic fallout was more in 2019 than was in 1918. Of course, 1918, the First World War just finished. We had the First World War from 1914 to 1917. And then you had the Russian Revolution. So we had a medical crisis, health emergency. We had a financial and economic fallout, which was a crisis, which brought about a growth collapse and financial system failure, but that was well managed. And then when the recovery started, we now have the geostrategic or geopolitical crisis arising from the Russia-Ukraine war, or let me say the Ukraine-Russia war. No, I don't have to go into the details of the impact, but it's quite clear that the time between one recession and the other in the US in the last 10 years is about 4.3 years. In Nigeria, it's about almost 5 years. No, I think the US is about 5 years, and Nigeria is about 4.3 years. The time between one recession and the other. So between 2019 and 2022, there's been one recession in Nigeria, one recession in the US, and one recession, the global recession. Secondly, there was a stimulus. The difference between this recession and the previous recession, which was the 2008-2009 financial crisis due to subprime mortgages and all of it, is at this time there was coordination of monetary policy activity across the world. There was quantitative easing, and there was also a massive fiscal stimulus, coinciding also with the vaccines, the COVID, the palliatives, and even the multilateral agencies, the IMF, the World Bank, actually put a lot of money into the system to prevent what happened in 1917-18, where after the World War and after the Spanish flu, we now fell into the biggest depression, that is 1928-29 depression. This time we've avoided that. And now, but what has happened in economics, there's nothing like a free lunch. What has happened is now you are now beginning to see this wave of inflation. All right, not runaway inflation, but what we can call hyperinflation. And therefore, we are having to respond to that. In the midst of that, we now have the Russian or Ukraine-Russian war. But also, we also have the threat of another wave of COVID. Gordon Brown announced this morning that because of complacency in the Western world, we are going to face a major COVID what they call another wave of COVID. And I think this morning also, North Korea, which claimed that they had no case of COVID, has now declared a state of emergency. The joke that time was that the 32-year-old president of North Korea ordered that anybody who was seen with COVID should be shot at sight. And therefore they had none. But now they have a major outbreak. They have announced it this morning. So that's the context in which we are going. But this is an investor conference. So what does this all mean for investors? You have the policy-making environment. You have the economic analysis that you can see. And then you also have markets and then investors who straddle all of this. And we are now talking to investors. Certain things happen, COVID effect, uncertainty, volatility, ambiguity, and so on. What we call it VUCA, volatility, uncertainty, ambiguity, and complexities. Now, politics, many things happened. When COVID started, Trump was in power. This time, there's a Democratic government in place. When COVID started, Angela Merkel was in power. At this time, we have a new man in place. When COVID started, Russia was intact. In fact, we had the World Cup in St. Petersburg. Today, Russia is an embattled country. When COVID started, the richest man in the world was Bill Gates. I think the guy from Jeff Bezos. Today, the richest man in the world is a man of African extraction, Elon Musk. So things have changed in such a short period, 2019 to 2022. What has happened to the markets? We saw the markets. The S&P gave us a return of 31.5 in 2019. 2020 we got 18.4 and 28.58 in 2021. But today, we're already minus 14 or so. So markets are always finicky, and investors are always scared. What they don't like is lack of confidence, lack of certainty. And when there's a lack of confidence, there's paralysis in the markets. But therein lies the opportunity. So what has happened in sub-Saharan Africa? We've had a recession. We've had a commodity boom. We've had a borrowing binge. We've had fiscal adjustments. We've had African countries benefiting from flows from multilateral agencies. We've had a shift in emphasis to Africa becoming a technology hub, but also a major shift from what we call mineral resource nationalism, where we had blood diamond, blood gold, and all of those things, to oil and gas emphasis, that is Nigeria, Angola, Equatorial Guinea, and so on. Now, to what we call the electric vehicle battery ESG orientation. In other words, the most important countries in Africa today are Democratic Republic of Congo, which has the highest level of columbite in the world, and uranium. We have Mozambique, highest level of graphite, largest producer of graphite. We have Guinea, having manganese and aluminum. So in those days, we are coming to Africa. If you don't come to Nigeria and South Africa, then you're out. Today, who cares about South Africa and Nigeria? People are coming to DRC. People are going to Guinea. People are going to Mozambique. And people are going to Zambia, where there's copper. Why? Because you need cables, you need batteries, you need electric vehicles, and all of these things are coming out of here. In the United States, also they need liquefied natural gas, which comes out of Mozambique, Nigeria, and so on. So it's a changing environment, and like I said, the one thing that is constant in the world is change. What do we have in terms of performance? We're still at this point, we have the largest economy being Nigeria, followed by South Africa and so on. But when you look at the COVID cases, there's no correlation between the cases and the size of the economy. But there's a correlation between the amount of testing and the data integrity of a country with performance. South Africa, of course, because of their what you call data integrity and governance, were the ones that first identified Omicron. And what happened to them? They got punished for being honest. And not only in South Africa, but 12 other countries were banned from flying to Europe. Those less transparent countries that were opaque didn't suffer as much as that. So that's another lesson today. So the Nigerian experiment, because Nigeria is the center of gravity of Africa. So what have we got here? We've seen GDP growth plateaued about 2.2 by 2019. We're recovering from a previous recession, right? And a policy environment of drift to minus 1.8 in 2020 to plus 3.4 in 2021. As a matter of fact, I think the revised GDP numbers came out to validate this only yesterday, using the expenditure and income approaches, which validated the original output approach. Income per capita still $2,200, but don't forget that Nigeria has an informal economy, which is almost 30 or 40% of the formal economy. So if you have to use anecdotal data to do that, you will find that you have to increase that by 40%. So basically, our income per capita is probably about $3,200 per head. Inflation rate in Nigeria, depending on what you believe, has gone all the way from 11.39 all the way to 15.92. Inflation data is coming out on Monday or Tuesday, and therefore we expect it to be at 16.2, maybe more. Oil production suffering from vandalism and enlightened self-interest is down to about 1.4 million barrels a day. The oil price is stratospheric, it's about $107 a barrel. And the exchange rate, which is very interesting, and I'll relate this to the equity return when we get to some slides. The exchange rate before COVID was roughly around 282, 362, went to 470, and today is about 592. In other words, it's almost lost about 80% or 90% of the value. If you look at the return, which if you did a Naira return on equity, shareholder equity by the table, the slides you'll see that if you invested in Naira, you got a 9% return. But if you converted dollars, you got a 4% return, which actually mirrors exactly the 100% difference between the exchange rate pre-COVID and the exchange rate today. So again, numbers never lie. At one glance, I saw that, I saw it and picked it up. Therefore, an investor who decided to take his money out in dollars and brought it back to invest would have gotten 4%. An investor who stayed in Naira would have gotten 9%. And then you convert it after you got your return, you end up in the same place. External reserves was $38 billion, came down to 35. Depending on how you slice and dice it, it's about $39.12 billion today. Basically, but when you look at external reserves, you have to look at external debt. The external debt, depending on what data, if you use the DMO data, it was $10 billion in 2015. It's now $39 billion in 2022. If you use contractual and non-contractual debt, which is captured by the EIU, it goes from 60 to about $76 billion. So total debt in dollar terms, Naira, dollar put together is about $100 billion. So what are the things that concern investors? First and foremost, we noticed that foreign investors had all exited portfolio investors because they didn't know when they would get their money. And like you all know, JP Morgan removed Nigeria from the list, and including Serbia. Nigeria has a positive B plus and stable outlook, but yet Nigeria's bonds were taken off the list. Why is this happening? There's geopolitical tension, which is undermining recovery globally and within Nigeria. There's lack of policy clarity. In other words, ambivalence and uncertainty. There's a negative rate of return. You have inflation at 16 and returns of 4% of treasury bills, which is you lose money by going to bed. Currency is stable, but who knows what the fair value is, and we have many theories around this. And we have a stock market rally, which is narrow, but we also have a stock market rally that's supported fundamentally by companies that have dominance in their sectors, but also are not overly exposed to exchange rate risk. The companies that are doing well and sectors that are doing well are those who have hedged their exchange rate risk and have invested ahead of the almost imminent Naira devaluation. And Dangote had done that in Abajana and cement. MTN had done that by, they can find the base towers. Guinness and Nigerian breweries had done that by building the breweries 3-4 years ago. And you know that basically you use exchange rate of the old to buy your assets and you use exchange rate of the new to price your products. So what do we face now? Facing geopolitical tension. Therefore, how vulnerable are the African economies, Nigeria in particular, to commodity swings as a result of supply shocks? How vulnerable are these economies to policy ambiguity? How vulnerable are these shocks to a year, 2022 in particular? 12 countries are going to have elections in Africa. And Nigeria is having elections in 2022 going into 2023. So reforms are delayed and far from clear. There are conflicted interests. And in some areas, we never know what happens. There are the leakages in the economy. In economics, we have what we call injections and leakages. Injections are positive, and leakages are negative. So you can have a positive multiplier because of injections and investments. You can have a negative multiplier because investments are leaking out or revenues are leaking out of the system. So the exchange rate we've discussed, and I'm not going to waste time, but one of the reasons why you have your exchange rate in turmoil is because your inflation rate is high, your interest rates, which could have brought it into equilibrium, are low, being kept artificially low, and also you have political overhang and you have policy ambiguity. All of these are a recipe to distortions and a what we call a rent-sinking economy, crony capitalism, and the chickens have come home to roost, as you can see. The political class who have a 4-year lifespan, and the economic class who have a generational lifespan. It doesn't take long to know that sooner or later, your partial equilibrium analysis will catch up with you under a general equilibrium analysis. And it has come to catch up with Nigeria. You don't need to be a rocket scientist to know that when you do transaction economics as against policy economics, you pay a price for it down the road. So these are the markets. And the markets are the most efficient indicator. And this is what I told you earlier on. You look at the table, share price appreciation for Airtel, 47% return, MTN, 22% return, Dangote Cement, 14% return, in Naira Cement. So we have negative return on Nestle, -10, negative return on Zenith, negative return on GT, and negative return on Stanbic. The 5 positive return of 18%. When you take the average, total capital appreciation in Naira is 9%, total appreciation in dollars is 4%. So you can tell the exchange rate differential. So it's an efficient market. Asset classes, if you invested, the only thing that today we know, if you invested in Bitcoin, and now Warren Buffett, the 91-year-old Oracle Walmer, said it that Bitcoin was rat poison. And I think those who doubted him, and I saw people on Nigerian television saying, in the US that Warren Buffett was old news, yesterday's news, old school. I think we've seen it for ourselves. Bitcoin went as high as $68,000. It is now less than $32,000. So I want you to imagine if you bought it at 68 and said you didn't care what Warren Buffett, the old man, was saying. Now you probably know that what the old man says sitting down, a young man on top of a tree cannot say it. Okay. Now, African equity markets, Johannesburg Stock Exchange is $1.39 trillion. You can see the return on investment. But what's important is that the South African Stock Exchange is only about $328 billion. And the Johannesburg stock market capitalization of Johannesburg is 5 times its GDP. The Nigerian Stock Exchange has $62 billion. That's the market capitalization. And its GDP is $440 billion. In other words, Nigerian stock market is about 23% of market cap of GDP. And you can see in Ghana it's almost equal. Now, so how big is the GDP? How big is the market? How integrated are the markets into the GDP? Therefore, if you have a market-based economy, you'll see it and it shows up. And that's why people go into South Africa to invest, because the markets are an efficient regulator of policymakers. Here, anybody can do what they want, and you end up with orthodox or unorthodox policies. Well, what do we expect? Next week, there will be a money policy committee meeting. By tomorrow morning, we will know clearly who the chairman of that meeting will be. And we'll also begin to tell what direction those interest rates will go. But definitely, an interest rate hike is almost inevitable and imminent. And an interest rate hike means automatically that stock prices will adjust negatively, but also the exchange rate will appreciate once the interest rate moves, not just the nominal rate, but the general level of interest rates in the economy will go in that direction, and it will make an adjustment to all that we know. So investors have to watch out for that. So the NGX has been in a rally. Again, we have to be careful. Like I say, at times the sizzle of the market could fizzle. And they say, remember, we said in February that beware the heights of March, and we saw what happened in March. And now we are saying, don't forget that they always say, sell in May and go away. We're in May, we don't know what happens next. So are there opportunities? Yes, there are opportunities. We love telcos because, one, they're fully integrated. Telco infrastructure is, and yeah, whether you like it or not, they build those base stations when the exchange rate was 118. In fact, less than that, 88, 118. Some of those base stations, they're buying 5G equipment. They're investing about $1 billion. So, and they've made a good transition from voice to SMS to data and to fintechs, and now they have full PSB licenses. So MTN, Airtel, Glo, and others. You see, then you have the back end, which is the cyber cables, the cable, submarine cables, main one another's. That's the infrastructure that goes. So the last mile solution. We think we love the telcos. Now they've not increased their tariffs since 2002 nominally. And cumulative inflation from that time to now is thousands of percent. We think that they're asking for 40%. The government will meet them halfway. They will increase their tariff on some of their products, but also they're asking for tax breaks. So what do? They need to spend. Don't forget, when they were offering services, the price of diesel was maybe 150, 190 naira a liter. Today it's 650 naira a liter. So something must be happening. We like the breweries, even though they are elastic products, but the breweries are doing well. They've taken the hedge, and people must drink. When they're happy, they drink. When they're sad, they drink more. So energy, of course, you know that energy transition to sustainable and green energy from brown energy. We like that. We think that there must be reform because this current level of collapse of the grid and all that is not acceptable. 30 years ago, we're doing 3,000 megawatts. Today, we're still doing 3,000 megawatts. And yet we've pumped a lot of billions into it. And now we see its inefficiency. So a change in that sector is imminent. Are there risks? Are there risks? Yes, there are risks. The risk footprints are there. And most of it political risk, economic risk, and policy risk. So in summary, GDP growth will be positive. Q1, supply shocks will continue to haunt us for some time. We will have currency pressures, policy pressures, more than anything, political pressures. I cannot tell you who the cabinet will be in the next 2 weeks. Maybe Bosen will be the Minister of Finance, we never know. Maybe Chuka Asaka will be the Vice President, I never know. So, ladies and gentlemen, at this point, let me say thank you very much for having me.